Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world. This is our new series, LPAC, where we bring on previous guests on the podcast to answer your questions on how to build your venture fund. If you're a fund manager and need advice, you can submit your questions to me at cupofjoe.com/contact. That's CUPOFZHOU/contact. Today, we have the amazing Chris Douvos, founding partner at Ahoy Capital, a fund of funds dedicated to investing in enduring venture capital funds. He's the first person I asked to be on the podcast, and I highly recommend you check out his episode on season 1, episode 1, as well as his LP game show we did with him and Beezer Clarkson on season 2. And if you didn't have pen and paper or an AI note taker listening in for you, don't worry, we'll link all of this and the aforementioned in the episode description. So it feels only fitting he's the first person I ask on for this new series. So without further ado, enter Chris. You know the name of the game, so we'll get into all the show stuff later, but how are you doing?
Yeah. I think this is a great time to check in on all your friends, people you haven't talked to in a while, because I think a lot of people out there need hugs. The problem is there are a lot of people who don't realize they need hugs, who will need hugs soon. But I think there's a lot going on that is going to be really challenging for our ecosystem. And somebody, I was just on a text exchange with a bunch of buddies in the endowment world, and somebody was saying that Q1 letters are coming in, and they literally just said, I can read exactly what they said. Every letter seemed to say that portfolios have quote unquote limited exposure to tariffs. I mean, the reality is that what we're seeing potentially is like the breakdown of the entire post-war Bretton Woods, kind of system. And that's going to have radical impacts on everything across, the entire economy. And so to have, to say we have limited exposure to tariffs is one thing, but to say that we have exposure to what they really are saying is we don't understand the exposure we have to the broader economy as a whole.
Yeah. Oh my God. So that's your knee-jerk, that's your gut reaction when you see all these memos and letters saying like, hey, you know what? Tariffs don't affect us.
Yeah. I mean, look, everybody is always trying to put the best spin on quarterly results. I love how every single letter I get says, starts, we are pleased to share our quarterly letter with you. Like, I write my own quarterly letters. Sometimes I'm not pleased to share them, especially, one of my funds, all my funds are, I love them like my children, all equally, but differently. And there's one that's keeping me up a lot at night, and man, I'm not pleased to share anything about that fund, but I have to, right? And it's, I have high hopes just like I do, for my children, but we're getting on in years here. Ultimately, I think that's actually a big difference. That's actually something I think about between kind of just being a regular LP and being on an LPAC is the kind of authenticity gradient, right? Like there's what people I think say in public, and venture's also a game of a lot of posturing, and it's like the unbearable lightness of crushing it, right? Like everybody's always crushing it, and it's just, even in hard times are, kind of forced to put on that facade. And that's why I, kind of go back to say, like, I think sometimes people need hugs, because I think it's, there's a lot of burden to bear when you're kind of carrying that facade around, all the time, the mask of command, as they call it in the military. And so ultimately, when you can have authentic conversations with people and talk about, how, portfolio companies are chugging along or not, how there's ups and downs, and we live in a business of failure. Ted Williams once said, baseball is the only human endeavor where, being successful 3 times out of 10 can get you into the Hall of Fame. Really, if you think about it, in venture, it's such a power law business that, if you were successful 3 times out of 10, you'd be, kind of a radical hero. I think, a lot of people are happy to have, one good deal out of 10. So neither here nor there, but it's, we got some tough sledding ahead, I think.
There's a line, I'm forgetting the attribution here, but I remember someone saying like venture is measured not by the batting average in which you have, but by the magnitude of the home runs in which you do.
Yep.
And so I think that's like extraordinarily powerful when it comes to that. And so I think a lot about that. But I have 2 questions for you. One question of which is, when's the last time you gave a hug?
To somebody in the business world, Friday.
Friday. I love it.
Yeah.
Are you allowed to share the context of that hug?
It was somebody that I hadn't seen in a long time who'd gone through some, kind of personal and professional ups and downs. And we had coffee at Joe and the Juice here in Palo Alto. And it was just nice to see them. And, we had a moment of human connection, and they had some things go really, kind of sideways professionally. Yeah. And I felt like they just needed a hug.
I love it. That's beautiful. That is beautiful.
And it's actually funny because, thinking about hugging, and I think about this a little bit because, we're West Coasters, like we kind of like, hug it out. The Italians kiss, West Coasters hug it up. And I worried that, hugging would go away. First of all, it can be awkward. So, you have to hug, you have to hug appropriately. And consensually. But with COVID, we thought handshakes were going to go away. And there was the whole like crowd cheering the end of handshakes, like what an archaic tradition. And would we like be dapping it up forever? And then all my kids had the, the lock it up or the turkey or the, the jellyfish, right? All these different daps. But I feel like the, nature is healing, and we're, I think, the power of touch is not to be underestimated.
I agree. So speaking of the art of the hug, is there, and this is something I'm always curious about because there's some days I hit and it's like, hey, you know what? That was a good hug. And then there are other days like, oh man, that was like, I'm approaching from the left side. They're approaching from the right side. And that kind of like this, like there's this awkward little dance that we have. But how do you think about the art of the hug?
I think you want to be appropriately aware of people's boundaries. So, I think my kind of go-to is to kind of come in at like a little 30-degree angle, and you kind of get the like arm around the shoulder and you kind of give it a little like bro squeeze. And so I think that's kind of, sometimes you can come in at 90 degrees. There's different, kind of angles. You don't want to, somebody here on the West Coast was known as a 6-point hugger. Which apparently was not okay. And it was the 6 points for shoulders, hips, and knees. And that was, I think, really too close for a lot of people's comfort. Oh. So you don't want to be a 6-point hugger. I think, kind of 2 points of contact, kind of arm and shoulder are good.
Well, I asked you for the art of the hug. I didn't ask you for the science of the hug.
Art and science at some point blend. It's just all of a piece. I don't know. This is, I think, the most inane thing I've ever said on a podcast. But hey, hopefully, if it helps somebody avoid a 6-point hug, I'm here for you.
We're all about helping people, and this is like in the spirit of everything we're doing for this series as well. All this is designed to help someone else, even if it only helps one other person out there. It helps someone, so that's what matters.
There you go. Adding value.
I did say I had 2 questions. The other question is, how do you, and this is going to be a circle back, but like, how do you start your quarterly letters if things aren't going right?
There's always something going right. And I'm a big kind of literature guy, right? I love my like Walt Whitman. I love rhapsodizing about, the sunny and magical land in California. I see the genius of the modern, the child of the real and the ideal. Some days I'm like kind of cranky, and I started a quarterly letter once with the line from Gatsby about the Buchanans. They were careless people. They smashed up things and people, and I forget the exact line, but it's like actually. It's actually beautiful. Hold on, I'm going to look it up right now because it's actually, and they were careless people, Tom and Daisy. They smashed up things and creatures and then retreated back into their money or their vast carelessness or whatever it was that kept them together, and let other people clean up the mess that they had made. I've written that about funds, not fortunately my funds, but funds that have been on cap tables of companies that that I've been in through my managers. Yeah. And when you see bad behavior, and I've got like a list of funds that are on my personal
blacklist.
blacklist that are careless. And so I think when I wrote that, I actually, they retreated back into their money or their vast carelessness. And I changed carelessness I put a bracket, said their vast AUM or whatever it was that kept them together. But that's neither here nor there.
No, this is here and this is there. This is the whole purpose of the podcast. A selfish question. Where do you keep all these quotes? Are they just circling in the back of your head, or do you have a journal or some page you just keep all your favorite quotes in?
Some people have a talent, like they understand product market fit, or they understand, how to get to unit economics at scale, or some people can paint. I remember useless random things.
Not useless.
Sometimes it's flavor, it's color. Actually, it's interesting because I was thinking about. I remember when I started blogging 100 years ago, and as you know, I haven't written a blog post in almost a decade now, but blogging's been dead for a while. But there was a time in kind of 2012, 2013, 2014, and it was a lot of fun, and there was a little crew of us that were blogging, and Dan Primack said to me, he goes, what I love about your posts is like you have a voice, and it makes it interesting. And I've been thinking a lot about like AI, and I actually you heard it here first because I just had this thought this morning. I'm going to write my year-end letter, which I'm waiting for my last financials to come in. So it'll probably be out mid-May, which is awfully long lag. But my year-end letter, all with AI. Wow. And I want to see if it can capture my voice. Because once it does, I'm toast. And my value add, asymptotes to zero. Just kidding. This is like the whole like analytics, versus gut feel thing that's happened to sports, right? Like that's like the essence of investing, I think too. And especially in venture where I'm actually a little bit of a data nihilist. And I don't believe that data has a ton of predictive power, but that's a whole different discussion. But that said, man, if I could get AI to capture my voice and create a digital clone of me, that would be really interesting and impactful, and I think has implications for the entire knowledge economy.
The one I've been playing around with recently is Delphi. I don't know if it helps triangulate anything. It's Delphi. DELPHI.
Okay.
But that one's like, I've just been uploading, and this is just like a pet project of mine, but I've been just uploading my blog posts on there. I've been uploading podcast transcripts on there. And the goal is like, hey, you know what? Let's see how good this AI clone of me is. And so far, like, while it's gotten certain pieces of like content down, meaning like if I ask it a question, it gives a relatively accurate answer of what I would tell someone if someone were to ask me that. It loses the voice in which I have. And it becomes... And
you've got such a great distinctive point of view. And I think that's a big part of your charm, right? Like can AI replicate charm? Get out of here, man. Get out of here.
The thing of AI is fascinating to me because at some point I do think about how much we can individually scale our time. Like you and I, we both have 24 hours in a day, 7 days a week. Realistically, even if you're working, let's say 16 hours a day, 7 days a week, we still can't get to everyone who has a question for us or at any point in time, especially during these like, let's say hype periods or like quarterly periods or whatever it is, right? And I think AI is a great way to scale our time because oftentimes, I don't know about you, but I would probably say 80, maybe 90% of the time when I get questions, it's usually something I've gotten before. It's in very few times has it actually been net new of a question. And so I think AI will help a lot in that sense. Will it help in the relationship building part of it? Probably not. But at the very least, I can, give someone an answer that I would have written said anyways. Yep.
Yeah, I think we're living in a fascinating time, and I think everything is going to be up for grabs, and I think that creates a lot of opportunity, which is why I'm actually as excited to invest as I have been in a while.
Before we clicked record, you said something, and I was like, you want to say this on a venture LP podcast, and you're like, yes, I would love to say it on a venture LP podcast. And you just said something that seemed opposite, orthogonal to what you said before we clicked record. And I'd love for you to expound on this, but you said venture as we know it is dead.
Yep.
What did you mean by that?
Venture as we know it is dead. Long live venture. Kidding aside.
I was so excited. I threw my microphone on the table.
Kidding aside, I think that that the incarnation of venture today, filled with dilettantes and hobbyists who are buying long-dated, way out of the money options to get their, piece of the pie in the event there's, sliver of the pie in case of a, kind of a power law outcome. That kind of, long duration option buying is not going to fly much longer with LPs. Between the liquidity crunch, the stuff that's going on in the broader economy, the stuff that's going on with universities specifically, it's going to be a real challenge for people to raise money going forward. And I think that marginal dollar that's come into the space has really kind of changed some of the dynamics, over the last kind of 5-6 years. And I think we're going to see the pendulum swing way back to what venture used to be. And I think there's going to be a lot of challenge between here and there. That's kind of what I mean by that. That said, I've actually not been this excited about venture since probably 2005, early 2006, when I started perceiving the change in entrepreneurial finance that was going to lead to the rise of micro VC. That was the most excited I've ever been in my career, and this might actually surpass it.
Wow. And to help us fully understand, what are all the reasons you're excited about where venture is today?
Yeah. So the first, not to be polemical about it. That's a $10 word for my $5 brain.
Yeah. I don't even know what polemical means.
I don't even know what that means. I think I know what it means. Hold on. Let me, expressing a strongly critical attack or controversial opinion about, so I'm not being polemical. I
learned a new word though.
It's a good word. I believe really strongly that we are going to see a 20-year boom that's rooted in Tim Berners-Lee's vision for Web 3.0. Not Chris Dixon Web 3, but Tim Berners-Lee, at the outset of the internet, talked about the change from the static web to the social web to the semantic web, and in the static web, each layer iteration of the web has 3 layers: a compute layer, an interaction layer, and a data layer. And so you think about, the static web, Web 1, that's us sitting at our desktops, kind of clacking out, Yahoo, pages, and you had these, kind of straightforward databases and data transfer protocols that were, kind of in their infancy and what have you. And that was a very static way to access knowledge. Then with Web 2, you start to see the interface, the interaction, being, our iPhones were out, kind of in the world and creating user generated content. And we start to see, kind of advances in databases and that kind of compute layer. And I think that was that was a social web or kind of Tim O'Reilly called it Web 2.0, and that propelled, venture for a while. But ultimately it was I felt like there was something unfulfilling about it. It felt like it was transitory to something else. And that's where I think Web 3 comes in, where you've got now, the interaction layer, the human computer interaction layer, which is where we've spent a lot of our time investing, where you have pervasive computing and passive sensors that not only kind of analyze, but then can predict through AI, which becomes a compute layer and is now coming into its own. They can predict behavior and you have a data transport layer. And this is where Chris Dixon comes in, that has security and identity built in, and that's crypto. So now all of a sudden you have these three layers of the kind of compute infrastructure coming into confluence in a very powerful way that actually starts to fulfill the promise of compute for the first time, kind of in my lifetime, in a real way, where you have now software beyond the screen, right? As Sunil Nagaraj always says. And you see kind of real world impacts. We've been kind of automating automation for a long time. Started then automating dusty industries, but I think we're going to automate the entire economy and the entire fabric of life in the next kind of 25, 30 years.
Oh, that's a powerful statement. Fabric of life. Okay. Well, speaking of interrupting or disrupting the fabric of life, I'd love to bring on our first caller in. And so maybe I need to work on my transitions, to be completely honest. But, let's bring in Karen first, and we can go from there. Karen, what's up?
Can you hear me?
Hey.
We're on record already. I think you guys
Chris,
both
it's nice to
know
see
each
you
other
again.
already.
Good to see you again. How are you doing?
Yeah. Good. It's been, I think I met Chris over a video call. I want to say it's been over a year, right, Chris? It was he went on podcasts with you, obviously, Dave, but also with Ernest Sweat and assuming of allocators,
Yes.
I believe. And so,
Yep.
there were so many overlaps and people telling me great things about Chris.
Oh, you're kind to say that. Thank you.
I tell Chris this all the time. He's like, Chris, you got to do more podcasts. And if I can help in that, I will do it. That is my job. This is my mission I've been put on earth to do.
I will tell you. So in 2018, Beezer Clarkson and I actually recorded an episode of us just hanging out at the Creamery in Palo Alto talking. And it was amazing. It was just amazing. And it had this great, authentic, plates clanging and silverware and stuff. And it's the lost tapes. I still have them. We'll never air them because for
Why not?
compliance reasons, because we talked, trash about all these people. It was so fun and so amazing. And I wish we could really do that, but we just, kind of upset a lot of people.
The beginnings of OpenLP, if I remember correctly.
That's right.
Oh,
that's where it all started.
I love that.
Well, Karen, thanks for calling in. I know that we're using this radio show terminology, and we'll see how far this carries us. But Karen, for those who, speaking of Earth, and actually it's funny, Chris and I were just talking about changing the fabric of life and all that. Tell us a little bit more about you. Tell us a little bit more about Pachamama.
Yeah, thank you so much for the invitation, and I really appreciate it. So, I'm the founder and managing partner of Pachamama Ventures. Pachamama means Mother Earth, very topical in this week with Earth Week and Earth Day coming up, right? And I'm actually in Dallas. I'm in a different setting than usually. This is not my home. This is actually my mother's house, and this is my brother's room where you can see all his games. He's a gamer. Setup. He's a big-time gamer. So.
Oh, look at that.
So, this is not my usual setting, but anyways, I'm here for EarthX, E-Capital Summit, which is the second year in a row, I think, Dallas-based, this interesting conference of conservation meets conservatism, if you will. But anyways, I digress. So, Pachamama, we invest in early stage climate tech companies, and climate tech as a phrase that I realize is rebranding and becoming something new, right? We're in a third era of when clean tech, climate tech, and now ? And it's actually an opportunity, I think, in my mind to pivot to what we want to call it and what we want to decide to back, right?
I have a question, though. Which is, you mentioned that we're shifting towards a third terminology for climate tech. You speak clean tech, now climate tech. It's going to be something else in the future. Do you have any votes that you would put in the ringer for what it should be called?
Yeah, I have a few words that I decide to use depending on where I am at and who I'm talking to. And as you can imagine, when I come back to Texas, which is where I actually spent 14 years of my life, I studied in Texas. I went to college here, right? Dallas, Fort Worth, and then I got my MBA at UT. Anytime I come back here, it's less about climate tech, which gets me some interesting looks, right? Like blinking and like, what do you mean by that? Does that mean polar bear welfare? Ooh, is this a nonprofit? And like, do you even care about energy? Of course we care about energy, power generation, right? Energy storage, all of these things that really have to sustain and build an infrastructure that is more resilient. And I'm hinting at the word that I'm using, resilience, right?
Yeah.
So resilience is a favorite. Build infrastructure, not just build, but also data infrastructure. Anything that really essentially supports us to become more resilience, build resilience to short-term and mid-term shocks like those posed by climate change, right? Climate is becoming less of the war, and it's more, I don't know if you've noticed, but people are stopping to be concerned or talk about climate so much, and the conversation has switched to weather, right? Extreme weather patterns and situations, because it's no longer this 20 years ago, if you remember Al Gore saying these things about climate change and people looking at him as funny. It's like, okay, this is a problem for my grandchildren probably. And now we're in this era where it's like, oh, it's right here, it's happening, it's actually putting all these assets at risk, and it's making everything more costly to operate, right? So it's a new era indeed.
I love that. Resilient infrastructure, or infrastructure resilience, or something like there is. Yeah.
You heard it here first.
Yeah. And love it.
So Karen, you have a question for us. You have a question for Chris. I'm just here to listen in. I'm going to fly on the wall. But what is your question for Chris?
Yeah, I mean, I think you probably see it coming, Chris. I mean, I think with all the IP window still somewhat shut, and like the liquidity crunch happening, and LPs waiting for, still waiting for DPI, I think the conversation has shifted at what are ways to really get that liquidity in the interim, right? And one that I focus on is M&As, because it's actually 95% of global climate tech exits in 2024 were through an M&A, not an IPO, right? An IPO is actually rare in any tech sector, not just climate tech. But my question would be about secondaries, because that is entering the conversation more and more. Like, how do you do secondaries? There's got to be a right way to do them. And just like, don't, get as tactical as you can in the time that we are allotted, but really would love to learn from you.
Yeah. Well, look, everybody. So let me tell you, when I started in this business almost 25 years ago, secondaries were kind of a dirty word. If an early investor jumped off, it was a signal, right, of lack of conviction in the company. And I think we've gotten to the point where, fortunately, there's a bunch of dynamics at play. First of all, entrepreneurs and the market understand that early investors need this liquidity. Second, later stage investors have such big pools of capital that they're voracious for ownership, particularly in their winners. So I think the stigma of secondaries has really lessened quite a bit. And this question of time is an important one. I'm a fund that I was a partner in at TIFF is a 2006 fund that is still going. Right, we're in year 19 of that fund, and it's done great, but it's like, my God, at some point, can we, get out of this thing? And that's very common, for LPs. And I think it's a problem, and I'll get to your tactical, question in a second. But Jada, this goes to like the bigger, kind of meta issue, which is, I actually think, and we can talk about this more, I don't want to take up much of Karen's time on it, but I think venture doesn't know the train that's headed down the tracks to hit it. Every investor I talk to, and I talk mostly to endowments and foundations, but every single one I talk to right now is thinking about how to shorten the duration of their portfolio, right? People have too many long-dated way out of the money options. And quite frankly, they haven't, in recent memory, been appropriately compensated for taking those long-term bets. And there's a lot of other dynamics at play that, kind of suggest that they will continue to not be appropriately compensated. And so I think we're going to see a wholesale reevaluation of venture as an asset class by institutional investors. And I think that that's bad news for a lot of people. That said, I have to say, I think this is, David, I said earlier, like, kind of venture is dead, long live venture. I think this is actually this is the most exciting time to invest that I've perceived in a long time. So I think people need to start thinking about liquidity, A, to keep their existing investors happy, and B, to the extent that they're looking to raise capital. I think, moolah in the kula really stands out. So then the question is, how do you do it? Because what you don't want to do is you don't want to sell too early. You don't want to be the person that sold, I know somebody that sold Uber when it was at a $600 million valuation. And, that went, and by the way, I probably would have, because at the time, $600 million was like an outstanding, exit. Fortunately, I did not have that. I did not have to make that choice. My boys at first round had diamond hands. But that said, one thing I've heard is there are some people out there who are selling a portion of their position, like 20%. And by the way, we've seen this. Several managers across our portfolio have sold secondary. So sold kind of 20%. So you get liquidity back. If something's like marked up, if you're like at a 5x markup, that returns that position, and you still have, kind of 80% of the position riding. Depending on how big a position is, you might want to, kind of return more. So you're not just returning, you might want to sell more. So you're not just returning that position. But I think in a lot of cases, the general consensus is people want to hold some. I think in the public markets, they call it schmuck insurance. You want to make sure that you're not the guy who sold at 600 million, Uber. So there's, a bunch of different ways to do that. The other thing that I want to kind of point out here is one thing that I think venture needs to think more broadly about is not only kind of traditional exits in terms of IPOs or M&A or secondary sales, but also I think there's a lot of capital in the kind of growth equity and buyout spaces, especially that's kind of focused on tech. And we've seen a couple of, the kind of Vistas of the world, those types of folks, Advent, lots of other folks. There are a lot of people have Golden Gate kind of pioneered some of that tech buyout back in the early 2000s. There are a lot of people who I think are interested. The problem becomes one of valuation, right? Because they actually in finance, you're always selling to the greater fool. And I think one of the, kind of problems with the bed we've made for ourselves in venture is the valuations have gotten so frothy that nobody wants to, buy these companies. But that said, there's no right answer. In fact, this is a great question for your own LPAC, because different people have different, risk, profiles, return expectations, liquidity needs, time horizons. Tax, that's not something I think a lot about because my investors are mostly endowments and foundations. But for instance, a big thing in early stage venture is QSBS or Section 1202 of the IRS code, which we shouldn't talk too much about because we don't want to make it a target because it's just an amazing. But I think with QSBS, I'm not an expert. Consult your tax. You have to hold for 5 years. And so if you're selling a piece in less than 5 years, I think you can get into some trouble. And by the way, I don't know anything about really QSBS. I'm just happy when I get a notice that says this.
Okay, we have all the legal disclaimers, go consult a tax legal.
Yeah, and I don't know anything about it. I'm not smart enough. That sounds way above my pay grade. Yeah, no, it's but your investor group may have some kind of specific. So you owe a fiduciary duty to them, right? I often think it's nice to sell a little bit to show people that you can get monetized. But ultimately, you can't look to the next fund. You got to do what's right by that fund.
Yeah. That's a great answer. I mean, I don't even know. David, I don't know if we have, if I had any follow-ups to that, it would be just where should GPs like me go? What is the resource to go to? Where do you even go to? When you want to learn so much more about this secondaries market, what are your go-to expertise?
That's a great question.
That's a great question. It's kind of a shadowy market. And in fact, what I would say is go talk to your GP friends. But the reality is that actually a lot of people are a little bit hush hush about it because there's sensitivity sometimes with the companies. I don't think companies like it when they don't love it. There's not a big signaling, but there's still some sensitivity. So I don't know is a short answer. Maybe ask some of your LPs. They might have different opinions than me. Certainly I have no monopoly on wisdom and take quirky looks at things sometimes. So, ask your own LPs if they have any experience with it. And if they have some clever stuff that they've heard, report back, please.
Will do.
One thing I've heard, if it's helpful, is you want to book DPI if you can sell anywhere between 30 to 50% of your stake for at least 0.5x DPI, ideally 1x DPI. If you sell it and it's like 0.1, it's really not worth it in the longer scheme of things. So that's one. The flip side of this is like, how quickly is your company growing, right? If the company is growing really, really quickly, then might be worth it's like the example that Chris gave earlier, $600 million valuation for Uber. Right. On the flip side, if the company isn't growing as quickly, maybe they're going through sticky patches or whatnot, and their last round's valuation was a little healthier than, let's say, public market comparables. So I think Enterprise sits at like 7-8x right now. If they're sitting at like a 15-20x, might be worth doing that. If they did raise during 2021, you're probably going to take at like anywhere between a 30 to 50% haircut on that price. But if they raised after that, maybe your chances are a little bit better. Again, not legal tax investment advice, but things I've seen in the market.
And I think that's an important point because you do want to make it meaningful, right? Like if I see a fund with a 0.1x DPI, it doesn't get me really excited. I think the minimum level of distribution you'd want to think about is a 0.3x, and probably closer to, as you said, 0.5x is probably about right.
Awesome. Well, that was my question. Thank you so much, Yuval.
Well, Karen, thank you so much. We're going to put you back and there and wait for our next caller. But thank you so much for asking that question. For folks who want to find Karen, you're everywhere. So it won't be hard to find you.
Yeah, I'm on LinkedIn. So if anyone follow me on LinkedIn, it'll be good to chat with you. So thank you so much. I'm going to hang.
Keep up the great work.
Thank you so much.
Absolutely. Stay awesome.
Bye, Dave.
Yeah. So I guess what do you're probably seeing a lot of secondaries. Everyone's talking about secondaries now. In your experience, are secondaries transactions actually happening, or is it mostly just talk?
So it's weird because we live in such like a bifurcated market where the hot companies are really, really hot, and the companies that aren't just really aren't, which I think is, as it kind of always was. And so there's really no market. There's no market clearing price for secondaries there. And I think a lot of GPs find it a challenge to sell into a hot company because they think that it's going to, keep cranking along. And by the way, we are seeing some instances of down rounds, right? Like even in hot companies. And nobody wants to book a loss, right? So relative to their last round, so there is some of that we're seeing, but ultimately, I think there's more talk about it in the market, which I think is healthy. Like I said, we've seen it a couple of times in our portfolio, but it's probably a handful of times. I have at Ahoy we have 9 funds, kind of comprising 9 of our funds comprising probably 90 underlying fund vehicles. And the number of times this happened is probably, I could count on less than 2 hands.
Okay. I mean, I think a lot about that, something you said actually in our first episode together, season 1, episode 1, by the way, which is entrepreneurship is like a gas. It's hottest when it's compressed. And it's so good. I mean, you are one for mic drops.
Get out of here. That's funny.
Go for it.
This is how I feel like an old guy. Like I remember the first time I said that.
When did you first say that?
I said that in 2002, and I was at Princeton, and we had a venture fund from San Diego, and they're talking about and I love San Diego. It's like it really is America's finest city. And I think there's some great tech down there actually, but I don't know if there's a I think there's a great incumbent ecosystem. I don't think there's a great venture ecosystem. There might be. I'm going to get some hate mail. But I remember saying that to somebody. I said, look, you look at Silicon Valley, and even in its broadest, kind of incarnation, it runs from Petaluma to San Jose. Mm-hmm. You look at San Diego and you get, North County and South County, and it's you have all these clusters. I'm and by the way, everybody's all spread out and but entrepreneurship is like a gas. And I don't know why I said it. And I always want to have these bizarre, remote associations because they're memorable. And voila, there we go. I've been using that ever since.
I love it. Oh my God. So this is, if I'm doing my math right, 23 years in the making.
That the memory of that conversation is old enough to have a drink.
Oh, that is true. That is true.
I hate
2 years past legal age.
Yeah, exactly. This is, I got a little gray hair here, but we call it wisdom.
We call it looks. We call it fashion these days, right?
Oh, okay.
Salt and pepper, you've got it.
You're too kind.
I've always wanted, so I don't have nearly as much kind of salt and pepper in my hair, although I'm starting to get it. My parents are freaking out because they're oh my God, David's lost the Asian gene. He's aging way too quickly. And then me, I'm I think hopefully I look wiser now because this is all I can grow from mustache and beard, unfortunately. So I'm stuck there. I'm not blessed in that sense, but maybe there can be some whiteage that I can add to all this.
I like it. You're a dynamic gentleman. So you're very elegant. I like it.
Still young in the grander scheme of things and never stop learning. One of my favorite lines when I was back in school was they had this line where it says student always, and the dean at the time, I believe still is the dean there, was even when you're my age, and he was 60 something years old, he's you should still be a student always. And so I think venture is an industry that allows us to be a student always, which I think is really powerful.
I have the best job, and it really does keep me young. I get to live, a few years in the future, and what I love is we've been backing some kind of younger managers, and I had during COVID I had a lot of introspection because a lot of the people I grew up with in the industry, Josh Koppelman, Rob Hayes. And then the people that were investing when I, first came in, at Princeton, we were investors with Jeff Jiang at Redpoint. And, all these guys are so successful, and they're still involved, but they've kind of generally moved on. But as LPs, we kind of have a different timeline. And it's been really exciting. We just backed Amanda Robson, Robbie with her fund, Modern Technical Fund. I'm super excited about Robbie, and she brings a new energy to it. And it really keeps me young. And staying on top of new developments in tech, it really makes me a utopian and an optimist. I love it.
I love it. Speaking of being optimistic, I'd love to bring our next caller in, Kevin Jiang from Mangusta. Kevin, what's up?
Hey, David, it's good to see you, man. Sorry for the slight delay.
No, you're good. Stay mobile.
Yeah.
For those watching on video, they'll have a little house tour.
Exactly. It's good to meet you, Chris.
Likewise, great to see you.
I assume you guys haven't met before, so maybe
we haven't.
Kevin, give some high level to both the audience as well as Chris. What are you working on at Mangusta? And how did you get here?
Yeah, absolutely. So I'm Kevin Jiang, managing partner and co-founder at Mangusta Capital. Mangusta means mongoose in Italian. We're an early stage AI-focused VC fund, specifically tackling vertical applications. So we like to think of ourselves as the mongoose in Silicon Valley, really trying to find the best deals, hunt for the hungriest founders. Before starting Mangusta about 7 months ago, I was at SoftBank for the last 8 years nearly, helping build out the Vision Fund. So as part of the early team here in Silicon Valley, I used to fly to Tokyo 7-8 times a year to bring founders to meet with Masa and build out the Vision Fund portfolio. So that was a really fun experience. Got to do a bunch of marquee deals across supply chain like Flexport to cybersecurity like Wiz, which got acquired by Google just about a month ago. So been a really fun journey, kind of starting my own fund and being able to meet really interesting LPs and co-investors, and also really starting to kind of lead a lot more early stage deals.
Nice.
And so for those that are curious, or like, I actually didn't know the mongoose analogy until you walked me through it. Like, why mongoose?
Well, it's an interesting question because I think, the mongoose, for those who aren't familiar, is this really fierce little animal that actually kind of punches above its weight. It actually fights cobras and snakes and has a lot of symbolic meaning in a lot of cultures and fables, like Rikki Tikki Tavi. And I think for us, the idea is that venture capital started as a cottage industry where the focus was more on driving, outsized returns, having smaller funds, and, kind of giving companies capital to really grow exponentially. Where I think the later stage and the overall asset class has become quite different from where it started. Folks are, deploying large billion-dollar checks. Valuations are quite high, even sometimes in a pre-seed and seed stage. I don't want to, pick on anyone, but I think for us, the mongoose analogy is really trying to do more with less and trying to have a super lean and focused team that's able to really punch above our weight. And so that's really how I think about, Mangusta and the mongoose that we are in Silicon Valley, really going up against these titans and trying to show that we can drive still stronger top decile returns. And because of the small fund size, that's one of our advantages, to be able to move quickly and do a lot of damage.
I love it. And so you have a question. So let's say Chris is on your advisory committee and you have a question for Chris. I'm curious what that question is.
I guess I wanted to ask, like, what's the right balance for staying top of mind with LPs in terms of communication and check-ins without being too overbearing, especially, in between fundraising meetings and portfolio and new deals, and also in between funds, perhaps? How do you kind of like to be updated on progress, wins, any strategy shifts, and what is kind of like the cadence or the type of stuff that you really care about kind of hearing about, and what is your preferred method of engagement?
Yep. I get asked this question a lot. And I used to give an answer that I thought was a good answer, but I think it's evolved a lot. And what I'll tell you is you really need to understand, and this is just generic advice, understand the types of investors that you're targeting. So high net worth investors might have a different cadence than endowment investors, who might have a different cadence than the consultants who intermediate pensions or what have you. There's a big spectrum of investors, and all have different kind of preferences and footprints and what have you. So I can only speak to kind of endowment world, and because that's my heritage and my investor base, and then I wear the fund to funds hat is kind of a practical, kind of vehicle. And what I'd say about this is, I remember, when I was, kind of 05, 06, there were like a dozen funds that I really cared about, right? Like in the micro VC, kind of world. And by the way, we invested in like half of them, which was wild. And we should have invested in all of them, except one. And so
we won't name any names.
No names. No names at all. But now there's 4,000 funds, and literally on an average day, I get a half dozen. In fact, we've been talking for like probably 45 minutes here, almost an hour. And I bet I have like, 6 to 10, notes from folks. And so I actually sent out, I'm on a little group chat with a bunch of endowment investors, and I sent out here's what I think. What do you guys think? And basically the consensus seems to be, there's a handful of thoughts we have. So one, everything you say should be important and authentic. Somebody in our group chat said, somebody emails every time they have a good conversation with the founder. And it's like, Great. So everything has to have some like level of heft. And this is a tactical thing, a level of heft to it. Kind of what I'd call thump value, like you put it, on the desk and has some impact. And it has to be authentic to you, right? Like I get some of these, like everybody's got email automation, especially the go-to-market guys. I get like a weekly newsletter from like 4 different funds. And I'm like, okay, you're using on me what you tell your people, to use on their potential customers. Great. And it's just like, I just auto-file a bunch of them. So that's thing one. And so by authentic, I mean, make it tailored. And again, one thing actually stepping back a little bit is what surprises me is how few GPs I talk to actually have any idea who I am before the call starts. And the first thing you tell your companies, your founders, is like, know your customer. And and it's not just me. And I said that once, and somebody said, well, wow, you got a big ego. And I put in my endowment chat group, and somebody's response was literally like, how hard is it to like do a quick Google search on X university? Right? Like, so know something about them, their liquidity needs, like, their portfolio. Maybe there's news on who they've invested in. Maybe that starts to give you a footprint. Like, ask questions, come with kind of curiosity, not sales, right? Like, so that's kind of thing one in terms of authentic. Then every communication should, you can say all kinds of things, but the proof of the pudding is in the tasting. You are the sum of your actions. Right? Like, what does Forrest Gump say? Stupid is as stupid does. As I do a lot of stupid things, but but ultimately, like, your body of work paints a picture of who you are that is sometimes different. The Venn diagram of that might be like 98% covering who you say you're going to be, or it might be 50% covering. I think a lot of people lack awareness about that gap. And so they're trying to say there's something they're not. So everything that you do is the mosaic of you, and there's a thread that runs through it. And I'm not saying it all has to be perfect, right? You want to get, the reason I say mosaic is there's sometimes discordant pieces in a mosaic, but they make the mosaic more beautiful. We had a fund that I invested in 2006 that had like a primary strategy and a secondary strategy. 80% of the dollars went into deals that they seeded and incubated, and 20% went into like network deals, where they had like, unfair access, but only, kind of a small check or whatever. And they did Figma. Right. And so that has worked out well for them. But it was all part of this mosaic of who they were. So as you tell the story of you, tell it, let your actions kind of speak for you. And then ultimately the biggest takeaway here is like, what you're trying to do is articulate a sustainable competitive advantage. Right? Like, a lot of people talk about differentiation, but ultimately it's like, what is it that makes you have an unfair edge? Right? Like, how is it that you have, because by the way, another thing, like, investors are trained to say past performance is no guarantee of, a future success. But what we're looking for is repeatability. Right? Like that, if I boil down like what LPs are looking for, ultimately it's just repeatability. And I have to give all credit to Andy Weissman at Union Square. He says, process drives repeatability. That's the way Union Square comes at it. They're very process-oriented. Process drives repeatability. For some people, and I think this is a weak example, but like network drives repeatability. But I think networks are really fungible and like, but there's some people like I've talked about before in other episodes, like, like for us, we invested with Ross Fabini in 2016, and I was spending a lot of time at Palantir, and I had this big Palantir hypothesis. And I was asking like Palantir employees, I'm like, which VCs get Palantir? And they're like, oh, all the founders guys, Lonsdale, all those guys. But man, there's this guy, Ross Fabini, who like walks around, and we thought he was a co-founder. I'm like, that's the guy I want to invest in, because that is a robust, that's more than just like, I was employee number 1312 at Twitter. And know a bunch of cool kids, which by the way is a recipe for just getting into, kind of overhyped, overpriced momentum deals. Sorry if that if somebody caught a stray on that one, especially if the person I have in my head caught a stray. Sorry. But anyhow, so sustainable competitive advantage, the mosaic of you and through your actions, and important and authentic. And then the last thing, one of my group chat folks just texted me, and they said that and actually, this is what I'll say: the worst time to figure out who you're going to marry is when you're like buying flowers and setting the menu, right? It's too late. So what I would say is most funds that are raising now, especially with institutional investors, we're getting to know you for fund N+1. Mm-hmm. Right? Like there are definitely a lot of people out there who are window shopping, but realistically speaking, my book is set for this year and probably next. And I want to get to know people. And not only that, but like we invest in people, right? Like I want to understand your behavioral footprint as an investor. And that takes time. I got to know Josh Koppelman for 2 years before before he even had started, first round. There's certainly exceptions to that, but I want to get to know people over the arc of time because then you learn their behavioral footprint. So you're always thinking, whenever you meet with somebody, it'd be nice if they came into this fund, but it's probably a fund N+1. And then to that end, one of my buddies on this chat said a half year or maybe even quarterly check-in live, preferably, or by Zoom. I feel strongly that people run together in Zoom. I think it's important to have a sense of place when you meet somebody, and you can contextualize them better and they're more sticky in the memory. So the more people you can meet live, fine, but Zoom I think is a necessary evil. And then this person says something interesting, which I think is too many calls that I get on, it's like a rehash of what the strategy is. And assume if I'm taking the call that I know what I actually like spent 5 minutes reminding myself of who you are and what you do. And so really, really getting to those, kind of quarterly, or semi-annual check-ins with, kind of high people you kind of vibed with. And don't be afraid to show, this is the last thing I'll say, I'm sorry, I've gone on a while. But don't be afraid to show the warts. One thing I hate is when I meet with somebody and they tell me about companies A, B, and C, and then the next time I meet with them, it's companies D, E, and F. And it's like, well, what happened to A, B, and C? And so like, I've told people like, hey, when we're having like serious conversations, like help me understand the arc, right? Like you're giving me, as LPs, we get snapshots in time, but what I want is enough snapshots of the whole scene to create a movie of you. Like, one of those like picture books that you can flip and see. I want to see the evolution, right? That's, and that, I want to know about the hypotheses that you're testing that didn't work, right? Like both in your general fund, but as well in, in portfolio companies. I want to know where things like where you tried to help portfolio companies but couldn't, where you tried to get into deals but couldn't. All of that is like more authenticity because this is a hard game. Nobody has 100% hit rate. And understanding how you're not losing, but you're learning and growing and going to grow into the person that I want to invest in and fund N+1 is great.
Yeah, no, it's absolutely super helpful, Chris. I appreciate it. And I would say, for me, I've approached all my fundraising conversations as longer term kind of relationship building, right? Whether it's not for 1 year, it's for 3, 5, 10 years down the line, because I hope to be doing this for decades. And so, really those relationships start today, but they hopefully continue for a very, very long time. And I know we're running up on time, so I'll pass it back to David.
The last thing I'll say though is like, I think what people don't understand, and I will name names on who I think broke this, but in a second, but I use this line all the time. We invest in funds as LPs that last twice as long as the average American marriage. Right. I was just talking about a TIF fund that I'm in. It's great fund. I'm super, that I invested. It's our calendar year 2006 fund, and here we are in 2025, and I'm still talking about it. And there's some good stuff in there still. And I'm just like, man, when will that last moolah, be in the kula? And I think, and this is like, this is not catching a stray. This is like, gunshot, sniper shot. Like, I think syndicates, I think AngelList like made it too easy to raise a fund. And I love the AngelList guys. They're important. I think they've done a lot of good for the ecosystem. But there's so many people who started raising rolling funds with literally basically, I'm going to get you in a bunch of deals and I'm going to dip. Like, I'm out, peace. And I think that really kind of created this like weird dynamic in the business, where institutional investors like me are like, man, we're like getting on board. I'm going to have to be answering to my committee in 10 years about the investment I made with you that's like only halfway through its life. Like, that's a difference. So, Kevin, the fact that you said this is like, what you're going to be doing for 20 years, that's the kind of attitude that I think people need to bring.
Awesome.
I love it. Kevin, thank you so much for the question. I'll see you very, very soon. And until the best, and until next time, stay awesome.
All right. Thank you, David.
Thank
Appreciate you having me, and great to meet you, Chris.
Likewise, my pleasure. Hope to talk soon.
Bye.
This is so interesting to me because as you and Kevin mentioned, a lot of it revolves around like you're staying in the business for decades, like longer than the average American marriage.
Yeah.
How does one show you that they're in it for the long term? Because everyone will probably tell you that they're in it for the long term, but how does one show you?
It's really challenging, and especially like you look at LinkedIn and people are actually, I'm going to say this in the most positive way. Stuart Alsop, who has been around forever, once told me something really interesting. I said, what do you tell entrepreneurs? He goes, I tell them, because the typical vest in Silicon Valley is 4 years, typical vesting period. Yeah. He says, think about how long you want to work. Think about, and then, how old you are now, and then how many years that period may be. And then divide that by 4. And that's the number of shots on goal that you're going to have to create like intergenerational wealth. And so when you actually do that, like it's actually like not very many shots. And so he then says to entrepreneurs, like, I want to know, like, is this the opportunity that you want to spend the next 4 years, on building that option value? And I think some entrepreneurs have said, ooh, this isn't quite that profound, right? Or this isn't quite the thing I want to spend that kind of. And I think that's like an interesting, little lens. But we live in a world where people have had operating roles, and now all the rage is for operators to come into venture, and it's really hard. So I kind of come at it with like, I don't believe anybody. I believe everybody's trying to like screw me over, which is like maybe my Brooklyn upbringing. Everybody's trying to get over on me. And so you kind of start with the null hypothesis being like, this person is a dilettante or a tourist. Yeah. And what you try to do when you understand their behavioral footprint is you try to understand their passion. And some people are builders for the sake of building and get their psychic income from the communities that they build while building. Yeah. And like, again, I'll like some of the people I've mentioned already on this, today is like, Josh Koppelman was a fund entrepreneur. I could tell that he wanted to hack the fund business. He wanted to turn in, VC on its head. And that was like his life's passion. Right. I saw Ross Fabini and I was like, Ross is like, he was described to me as everybody's favorite VP of engineering. Right. And I think Ross loved, kind of getting up to his elbows in companies. And that's the kind of thing that really, kind of grabs me. And I think a lot of people articulate that, but you can really see it when you kind of, unpack and understand, people over the arc of time.
So a lot of this is the fund N+1. So you actually can see them do this stuff instead of just what they tell you.
It's a challenge, right? Because if they've done a good enough job for you to invest in fund N+1, then fund N was probably pretty good. And you're like kicking yourself a little bit about that. So that, that's where I think in the last 5-7 years, I've been a little bit more trigger happy. Yeah. And the other thing is like, there's such a scrum for allocation, right? Like, there are a lot of people out there who are just buying fund one options. And just to kind of get it, a lot of people have really big portfolios, and it's tough for us because we run a pretty concentrated portfolio. And so I've got very scarce, landing slots at this airport. And so you're kind of like trying to walk that line of like, what's that last card to turn over? And the reality is, like, if you had infinite time, like, you can analyze, you can have an analysis paralysis and spend the rest of your life, getting to yes on something. So kind of calibrating that, like, when do you say go, is really hard.
So much to unpack there, but I want to give space for our next caller in.
Yep.
And so I'll bring in David from Stellar. David, what's up?
Hey guys, how you doing?
Hey,
have you guys met before? Oh no, I see.
We have not.
So I want to give a fun fact before I let David talk about Stellar and how he's gotten here and all that. David helped me name the podcast. Like, Superclusters would not be here today if David was like, so fun fact, before I started this, I wanted to call the podcast Laniakea, which David and I both knew what that stood for. But question for you, and this kind of proves David's point as well. Chris, how would you think you would spell Laniakea?
Is that a Hawaiian word?
It is.
So I would guess Laneakea, 2 words.
Pretty damn close.
Okay.
Laniakea.
Okay. And what does it mean?
Supercluster.
Supercluster.
Literally. So the whole thing is, like, we live in the Milky Way galaxy. What's bigger than the Milky Way galaxy? The thing that's the next order of magnitude bigger than the galaxy is a supercluster. The supercluster that Milky Way is in is called Laniakea because it was discovered in Hawaii. And it stands for immense heavens in Hawaiian. But that's it. I really wanted to call it that. David was the sounding board here and the rational person in the room where he was like, dude, no one can spell that. No one will get it. You should just call it superclusters.
That's I like the trend is simplicity.
So
I hate names. I hate the names of companies when you don't know how to pronounce it, right? Like, if you don't even,
right.
I don't mind a word that you've made up, and like, that's fine. But if you can't even pronounce the name the first time, then it's a dumb name.
Right. Yep. Boom.
Or Boom is a dumb name for a company. I'm sorry. For a supersonic airplane company, 1, you don't want it to explode, and 2, you don't want the sonic boom. So, like, why would you name your company Boom?
There is both a company and a fund called Boom.
That's brilliant. I love it.
It's just
stupid.
Well,
that's
actually,
funny.
This bleeds in well because, and speaking of Boom Supersonic, like, David, you used to be in that world, and you're obviously investing in that world as well. Like, could you share a little bit more about Stellar?
Definitely is not in supersonic aircraft, that's for sure.
No, there we go.
I'm more the space part of aerospace.
There we go. But yeah, can you share a little bit more about Stellar, and then can you also share how you got here? Because you have a very interesting journey. So
Stellar Ventures is a venture fund that I started with 2 partners, fund for space companies, early stage space companies. And we're investing in all kinds of areas. We usually don't invest in launch because we think that launch is a tough area to break into right now. But we invest in all of the things you do with cheap access to space. And so I learned about the space business in a fire, like champagne fire hose kind of way. I was at SpaceX as the general counsel. And the reason I got there was because I was brought in mostly because they needed some help with Starlink. They were just starting to launch Starlink, hadn't even, built the first satellites yet. And they were looking for someone with consumer facing experience. And turns out I have consumer facing experience because I was in the fictional space business. Namely, I was the COO and general counsel of Lucasfilm, George Lucas's company, and was there for 16 years, helped run the business, we did all kinds of TV and film. We did lots of licensed products. We did visual effects, all sorts of things. And of course, a lot of that is consumer facing, right? And so when I reached out, I had sold Lucasfilm to Disney, and then in 2012, and then I'd worked for Disney for a couple of years doing the integration, and then I did some startups in Silicon Valley, like tech startups, which is really my love. And at a certain point, I finished one startup in the VR space and said, hey, what's next in my career? And I sent a cold email to Elon Musk. And I said, hi, my name's David. I love what you do. I'd love to work with you. Here's what I've done. And, next thing you know, I'm the general counsel of SpaceX. So learned a lot about the space business and reusable rockets and launch costs and inexpensive satellite constellations. And of course, we also launched Starship, the first suborbital flights of Starship while I was there. We also did the first launch by a private company of humans into space with the Demo 2 mission in March of 2020. So that was exciting. So learned a lot about that. I met, of course, the SpaceX mafia, because nowadays, with SpaceX at $350 billion valuation, lots of engineers are leaving and starting their own startups in the grand tradition of Silicon Valley.
Nice. Congrats. Sounds like you've made some great progress.
Yeah, it's awesome. Things are going great.
I love it. So what is the question you'd love to ask Chris? Let's say Chris was on your advisory committee. The one question you'd like to get Chris's time on.
My question is how did GPs react when early stage funds want to expand into later stage, when they want to start suddenly investing in B, C, D rounds? Do you see it as a sort of a natural extension of what they've done before, or do you see it as something where it's a different skill set, different mindset, and you'd be reluctant to invest in a fund that was suddenly trying to expand, or not suddenly, but over time expanding into subsequent rounds?
I have a lot of thoughts, which I'll give in a second, but just to clarify the question so I can answer the question more directly before I go meta. When you talk about investing in later stage, are you talking about following on?
I'm talking, there's one is following on from second fund into first fund. I kind of get that. We've reserved a little bit of our second fund to invest in follow-ons and, get the LPAC to approve it, make sure you're not, cashing out, first fund people with second fund money, but et cetera. That's concern. I get those concerns. This is more, when do we start saying, hey, we're going to start investing in B, C, D rounds directly, especially as the fund grows.
And when this is the clarification, when you say investing in BCD rounds as your initial investment into that company?
Yes.
Okay. Cool. Okay. Let me answer then the first question first, which I don't think is actually a real question, which is what do we do about all this pro rata, basically? And you mentioned two of my
a tough problem to have. We should all have such a problem.
Well, it's an interesting problem. And look, when I was
GC of SpaceX, we did the GHIJKL. I mean, tons.
Yeah.
And there were the funds that had pro rata in those rounds were oh my God, this is these are funds that made their entire careers off that pro rata.
Right. So it's interesting because there's basically a whole cottage industry as if you look back in the history of venture, funds were life cycle funds, right? They invest in companies, and support them the whole way. Then every large market segments, you start having, early, mid blended funds, late stage funds. But the early funds typically reserved, and, over time, we did see funds that would and I'm not saying that you're doing this is just a more general thought. You'd see funds that do what actually Charles Hudson does at Precursor, I think really thoughtfully and well, and with intention, which is hey, we're only going to do the first capital into these deals, and then we'll SPV out our pro rata, right? And I think he's a very clever guy, very smart guy, and I know he's doing great, and he's a great dude. Historically, from the institutional perspective, that's been viewed as an angel strategy, like a sub-institutional strategy, right? Because the what Charles is saying, and I give the best of intention to this. I say this completely without judgment and with admiration. He's buying a portfolio of options, right? An educated portfolio of options, but it's a portfolio of options. Whereas I think, funds that reserved would then use their reserves, you would hope, strategically, right? And make, as Josh Koppelman would famously say, your seed round, gives you an option to, validate, disprove or de-risk an entrepreneur's hypothesis, and then you can follow on and blah blah blah. But I think what's happened is we've gone to a world where there are 4,000 funds and rolling funds and syndicates and everything. people started doing SPVs. And I'm sorry if this is pedantic for people, but like what happened is then you have this SPV industrial complex where there are a lot of people who love doing SPVs because they're like, now we're directly in companies, right? And you mentioned, hey, maybe we start, kind of offering SPVs to people who aren't investors. And I will tell you, I think SPVs are tragic, right? Because from my perspective, because basically, if you think about the world in terms of a portfolio of options, right? Like you are now long an option. You have deal by deal carry. So if you're long an option, who's short that option? Me, right? And I have no like governance, I'm basically just hoping you made a good decision. And then I have a piece of paper with, kind of a 10 to 15 year duration that may or may not work out. And I'm kind of stuck with it. But there's so many people that love these. So like, I can't begrudge it. I just feel like, and by the way, we've done our fair share of SPVs, partially because I want to say like, hey, we're doing direct deals. Look at us, like how smart and plugged in we are. But there's, kind of selection bias issues. There's all kinds of issues. And I don't love SPVs, but I realize they're kind of a fact of our landscape. And by the way, putting on my GP hat, man, if you can get people to sign up for SPVs, God bless you. God bless this great country of ours. Like, do it. And I hope they make your investors a ton of money. And you know what? They'll make you even more money and get it. Go get it. That's kind of how I feel about SPVs now. And we've stopped doing it. And I would rather, if I have conviction about the person, I want full conviction in the fund. Right. And I want to hit the fund with my biggest thump because I'm not really convinced that there's any kind of predictive value in SPVs. And there's been some interesting research about that. Enough about that. Too much talk about that. You are a very smart person and a general counsel. So you know the fiduciary minefield that you're walking into with the crossover investments. My own personal view, and again, this is not a consensus view at all, is that we as an industry are whistling past the graveyard on this, because as you know, and having grown up during like the great LP wars of the early 2000s, there was a lot of crossover investing, and then all of a sudden you had different series with different proratas, different rights, different pay to plays, different stuff. So I think as an industry, what we've said is, you know what, let's just get like ironclad like love from our LPAC on these things. And my guess is that's good enough. But whenever I ask a lawyer about it, they're like, yeah, that's probably good enough. But what if this happens? And what if this happens? And like, what I don't ever want to see is, this stuff goes sideways and people start suing people. Yeah. Right. But I acknowledge it's a strategy. And by the way, like I can make a straight face case that reserving that in your fund two actually shortens the duration of your fund two because it's a more mature company. It also slightly changes the risk adjusted return footprint of your fund. So that's something to think about too. Some people will be attracted to that, whereas other, who are more risk adjusted return, where other people like the Charles Hudson, let's like, all gas, no brake on, and that's what makes a market. It's a beautiful thing. So again, better than I do that kind of full transparency is important on that. Then I think what is your real question is like, okay, we're smart people. We know this space. Like, let's start doing later investing. And I will tell you, this is an area that a lot of people historically have struggled with. And I think LPs generally hate it. This is, and I put this out, I was saying on a prior call, I have a little group chat up right here with a bunch of endowment world people. And I kind of like just reality test. I'm like, hey, how do you guys feel about when this happens? And almost uniformly people's one was the like green, like I'm going to vomit emoji. Right. And somebody else said, one of my public market managers was doing small caps and then decided he wanted to be a big cap manager and we fired him. Right. Like, so it's, I don't know if that's the best analog. And I think that there is some value to domain expertise in venture, but you can make that case about the public markets. This guy, but you get my point. It's kind of a frustrating thing for LPs. I think some people, like one of my early 100 years ago when we were investors in Domain Associates, the healthcare people, when I was at Princeton, they brought on a public market investor to do late stage stuff, right? And now we're talking like E and F rounds, right? I know Floodgate has brought on, I think Iris was there. I don't know if she's still there. I haven't like really I know Anne personally from Yale stuff, but like we don't really talk about the funds anymore, even though I was an investor in funds 1 and 2 a lifetime ago. And so I think Iris came on because she brought like a mid-stage analysis set. And the way I think about it personally is there's like pre-spreadsheet and post-spreadsheet investing, right? And for me, it's a very different risk-adjusted return footprint, because once you are post-spreadsheet and companies, you talk about B and C rounds, companies, have product market fit, they're moving to traction wherever they are. That's a very different and analyzable, and my personal opinion is that that's super beta venture, right? Like it's just public market super beta. It's like 8 beta venture,
right,
or 8 beta public market, right? Whereas pre-spreadsheet is like Adam and God on the ceiling of the Sistine Chapel with their fingers, kind of like almost touching. You can feel the electricity, and you're ex nihilo. You're going to have humankind.
He being Da Vinci painting this.
Exactly, right? Like that is like the 0 to 1, right? And that's like
not Da Vinci.
Yeah, all of it, right? Like, that's to me pure alpha. That's, I think, the purest alpha left in the investing markets. But alpha can have a negative sign in front of it, right? Like that's right, like that. But that's the game we play. So I think they're two different businesses. I think it's hard. Look, we all think we're really smart, all that stuff, but I think it's really hard to wear both those hats as an investor. And by the way, and it does really start to mess with like you now are a different type of fund.
Yeah, right.
Right. With a different, by the way, clientele, right? Like what you do now is attractive to me. What you're doing then is not attractive to me. And by the way, that's who cares about me? I'm like some podunk guy sitting here in Palo Alto. There's a reverse too, right? Like that might be appealing. And by the way, you can put more capital to work there too. And so raise a bigger fund. And so now that opens up a different, kind of stratum of investors. Whatever you do, it takes me, this is the last thing I'll say. I get on these soapboxes. It's the Mike Porter definition of strategy. Strategy is an integrated set of choices that inform timely action. So anything you do, make sure that everything is aligned to support the choices. Strategy is choice, like the choices that you're making. And by the way, choices that you don't make is also a strategy, right? So make sure everything's aligned to kind of push you, per arduam ad astra.
Ad astra, that's that is the motto of the space industry.
The space economy is big, baby. Awesome. I love it.
Yeah, it's big. It's fun.
Cool.
It. Thank you so much for the answer. I appreciate it.
Thank you for the question. It's good to meet.
David, thank you so much. We'll have you jump out soon, but thank you for calling and thank you for asking your question.
Thanks so much.
Take care.
Have a great day.
I think that's a really interesting thing. I spend a lot of time with institutions that tell me they like to be the ones who diversify, not the fund managers to diversify. And in many ways, like diversifying across kind of stages they're like, we'll just like between picking the best kind of like early stage investor and the best growth investor, do we want that, or do we want someone who straddles both but is like top quartile or top decile, but maybe not the best, because the best really, as we know, like really changes a lot of it. So who knows? I mean, I'm sure there's an appetite for that out there.
And this is like an extreme viewpoint, but like I remember like early in my career, we were looking at a fund. This is on the buyout side. And these guys did the whole right side of the balance sheet. So the debt, the equity. And it was like a beautiful strategy for an insurance company because they had this debt. It had like a coupon for it, right? Like, but we were at this endowment. And basically like, when I think about the expected return of a fund, like I hope the expected return is 3x with like a standard deviation of like 6. I don't know if you can even have a 6 standard deviation, whatever. Like probably like actually the reality is probably a 3 with a standard deviation of 1.5x, right? Like and these guys, I think of these guys often because basically like we spent a lot of time talking about it. And we were like, look, this thing probably has an expected return of 2.1 with a standard deviation of 0.1. And actually like all their funds ended up being right in that, And after a while we thought about it and we're like, so why invest in that? Why invest what role does that play in our portfolio? Because, by the way, there's a world in which, and that was kind of our target for buyouts, because that penciled out to like a 15 IRR, and 15% compounded forever is a lot of money. That's how we thought at Princeton, which is, I think, an important way to think. And I was like, we had this moment where I was like, why wouldn't we put our entire, if that's what we believed, why wouldn't we put our entire endowment in that? 100 cents of the, the buyout. Because if you knew that's what you were going to get, but the reality is that we wanted to actually create diversification for, there's some obvious diversification reasons, in terms of industry and sector, and you want to avoid macroeconomic shocks and all that stuff. But ultimately, like, you build a portfolio because you want to catch those outliers. And especially in venture, it's a business of outliers. Yeah. And I think the later stage you go, the arithmetic starts to get challenging for outliers. Mm-hmm. And I think we've lived through this zero interest rate period where all the like real marks haven't filtered through the system. And I just saw PitchBook had a chart of like the aggregate value of unicorns and then the aggregate, exit value in the markets. Oh, yeah. And right, like, I think when all the dust settles and all the moolahs in the coolah, people look back and say like, wow, the arithmetic of this business is really, really hard. And so like, how are you hacking that? And for me, the answer is we're just buying the like most naked, longest dated, furthest out of the money options, because they have the lowest cost basis on the cap table. And it's a bet. I could be completely wrong, but it's a bet. Like one question I ask my investors, my funds all the time, I'm sorry if this is too long, but like one question I ask all the time is like, if we're sitting here 10 years hence having a coffee or a beer, depending, or a whiskey, whatever the mood strikes, and you won't have achieved, your kind of lofty expectations for this fund, what might have driven that? And some people take that question wrong. They're like, what's your biggest weakness kind of thing? And I'm like, no. Let's unpack some of the bets that you're making or the biases that you have that may not, kind of come to fruition. And then when you like start to unpack it like that, and for me, it's that, right? Like I have a very strong, first dollars in, mindset. And I could be, by the way, I think that's been like a little bit like not completely off step, but a little off step. Like we're underweight the unicorn sector, and I'm perfectly happy because I think in the fullness of time, but this is venture. A lot of weird stuff happens. Like dumb companies get acquired for stupid numbers, and you're just like, which is why you need exposure.
I agree. I'm so curious. Like, what are some of the most interesting answers you've gotten to that question of like, say 10 years from now, we're grabbing coffee, beer, whiskey, you name it. What are some things that didn't work out?
A lot of people give good but conventional answers. I think sometimes the answer is a starting point. Like an answer I get often is like, we didn't select well enough, right? Like we didn't. And then the question is, okay, why, right? Like there's this Toyota production element of the Toyota production system, which is like 7 whys. Like, why are we having a high defect rate on these seats? Well, because we use this foam. Why do we use this foam? Because it's cheap. Like why, right? Like if you have 7 whys, you get to the root of any problem. So I get bad selection. I get our sector went out of favor. I don't love that one because it's like okay, like then like I get it. It's an easy one, but it's like kind of the converse of people who try to pitch me on their sector. I'm like, we're meeting. It's like there's this great Don Draper line. He's like giving a pitch and the client's unconvinced and he gets up and the client's like, where are you going? And he goes, look, either Jesus is in your heart or he isn't. I'm not going to convince you otherwise in a 50-minute meeting. I think about that all the time. I send that to people.
Oh, that's a good line.
Yeah, it's like if you're looking for the clip, it's the Belle Jolie makeup pitch, and it's a great 2 minutes. He says, "I'm not interested in kabuki."
We're gonna put it in the show notes.
Clip it. It's great. I have had people say, I had one person, and I love the authenticity of it. They said, I might want to go back to operating. I might not like investing. I thought that was actually like really vulnerable of them to say. But more often than not, it's I'm just kind of racking my brain. Sometimes I get a really good one, but more often I get an okay one that leads to more questions.
Gotcha. 7 whys.
7 Whys.
7 Whys. You've given a lot of advice today, and you continue to give advice. If there's if I could just summarize, or maybe not even summarize, but if there's one more thing you'd like to share with our audience in a more general scope, is there anything you would like to share as one last piece of advice for this episode?
Ooh. Look, I think it's going to get the sledding's going to get pretty rough in venture. And the reason I think that is, I don't want to be like a sky's falling, Jeremy Grantham perma-bear. But, you look at endowments and foundations who historically have been an important part, whether they're 15%, 20%, less going forward, more going forward. I don't know. They've been an important, kind of intellectual backbone because they are the perfect venture investor because they have a long time horizon, low liquidity needs, high risk tolerance, all that stuff. And I would have added a few tax headaches. And that's one of the things that I think is underperceived in venture right now. I don't think venture funds understand how big a world of hurt endowments are going to be in. And there's this, kind of politics aside, there's a lot of talk about reducing, for research universities, reducing the overhead that they can charge to some flat rate, I think 18%. And I know MIT charges 62%. Why do they charge 62%? Not because they're being greedy bastards, because they actually have to maintain a whole infrastructure. So these grants have direct, kind of costing. And then they add in all this infrastructure for having the labs and stuff. That's part of the overhead. And they have, all this stuff. So it actually makes sense. You want world-class research, you got to pay for world-class labs and stuff. And there's this talk of, kind of reducing that to some number. And I know an endowment investor said, that'll put a 5 to 6% hole in our budget if it comes to pass. And then there's talking, they're talking about raising the tax. So I think there's a proposal to raise the tax, in the 2017 tax bill, taxes on endowments went from 0 to some excise tax. I think it's pretty small. It's 1.5% or something.
Right.
But now they're talking, there's a guy from Texas who wants to tax endowments at 27%. That actually starts to really, all of these things suggest a shortening of the duration. So we see, Yale today is in the news for selling, going out and trying to sell $6 billion of their, of their private portfolio. I think it's mostly buyouts. And I think they're getting out ahead of a wave. And so, and by the way, and venture just hasn't performed. The liquidity just hasn't been there. Right. And I think there's a real kind of where's the beef. And even when venture does perform, what's crazy about the power law is the headline numbers are exciting and attractive. But man, 90% of investors aren't in the power law deals, right? Or more than 90%. It's probably 10 funds that have done really well, right? So the average investor is wait, I invested in quote unquote top quartile funds, but wait, the top quartile hasn't beat the NASDAQ on a public market equivalent time basis, right? So you're that's a weird dynamic. And so there's going to be a lot of scrutiny. So I think the venture industry is poised to really shrink. And so I don't want to be negative Nelly. What I'll say is I think the opportunity here is, because I do think it's an amazing time to invest for some of the reasons I talked about before. The opportunity here is, hey, can we really crisply articulate our sustainable competitive advantage? How do we really give a sense for repeatability? Right? What is it that can give people confidence that we can continue to do in the future what we've done successfully in the past? And man, that if you can tell that story, there are definitely people. There's definitely money that's still looking to be put to work. That can have a lot of impact.
I love it. I mean, I was at this LP dinner the other day, and this large institution was all talking about, hey, it doesn't matter to get into the top quartile funds anymore. Top quartile sucks. It doesn't even matter to get into top decile funds anymore because top decile kind of sucks. And his words, not mine. But what's most important is you get in the top 1, 2, and 3 funds. That's all that matters.
Yeah. So, it's interesting because Samir Kaji did a bunch of work when he was back at First Republic, and he's a great guy, good friend, smart guy. And he found that there were 4,000 people investing. This was at the peak of it, right? And if you think there are 4,000 people investing and people are generally like on a 2-year cycle, that means that in any given year, there are 2,000 funds. So the top quartile fund is 500th.
Yeah.
500th. I don't want to invest in the 50th best fund, much less the 500. But that's like definition of victory. So it's like tyranny of the relativists, right? It's like, why do we care if our portfolio is top quartile if we're not keeping up with the opportunity cost of equity capital, the public markets? And so it's like really, the question I have that I throw back is how do you know who those top 1 or 2, managers are? And I remember in 2002 or 3, I was at a Sequoia annual meeting because we were big Sequoia investors at Princeton. And Mike Moritz said, look, in venture, the top 3 funds matter. And he said, probably the top 3 funds will be Sequoia, Kleiner, and whoever gets lucky, or whoever's in the right industry when that industry gets hot.
Right.
And I'm like, wow. So like, how do you invest in lucky people? Right. And so, for us, what it comes down to is like finding, and we have different ways in which we define, sustainable competitive advantage. But how do you find people who have some, unfair edge? And even then, I don't know if that's good enough.
Yeah. What's unique may not always make money.
Yeah. And by the way, unique and differentiated are words that like stress me out because like some things are unique and differentiated for like how much they stink.
Yeah, I remember we had this offline conversation about this where I was like, hey, I'm looking through differentiation and all that. It's like, call it something else, like call it like gravitational pull, call it like sustainable advantage and all that. And so that was like really helpful in terms of like what we were writing as well. So thank you so much. Chris, this has been so fun and always love having you back. This is obviously going to be the 3rd of many more to come.
It's good fun, man. Anytime. I love it. Great questions. I'm your humble servant.
I am the industry's humble servant. So, we're all serving the industry here.
Well, you're doing a great job. It's true. We can all benefit from some transparency. And I think you are a catalyst for that.
And if Super LP comes back.
I love it.
Let me know down in the comments or on socials if we should do more of these. Hope you enjoyed today's episode with Chris, and I highly recommend you check out his earlier episode with us. In fact, here's one of my favorite moments from that one.
Hold on a second. You guys. Do you guys know that you drew $45 million in management fees last year and you only drew $10 million for investments? You know what that does? That creates a J-curve. And when I have J-curve, you know what that means? My boss, Jack Meyer, this is the legendary Jack Meyer of Harvard Management Company, who is famous for paying people only relative to their benchmarks. Like you could get paid, it was always a scandal. Like people were getting paid $50 million a year for managing bonds at Harvard Management Company. But you could also get paid 0, right? Like it was all very quantitative. And so Dylan goes, so Jack pays me relative to benchmark. And what you guys are doing by drawing so much in fees and generating so much J-curve is you're pulling down my whole portfolio. You know what happens when my whole portfolio gets pulled down? Jack doesn't pay me. You know what happens when Jack doesn't pay me? I can't buy my kids a bicycle. And when I can't buy my kids a bicycle, you know what they do? They complain to their mom. And when they complain to their mom, you know what happens? I don't get any loving. So because of you guys, I'm on a dry spell. And we were all shocked. And I don't know if, obviously, I think Peter was joking because he's like a hilarious guy. But I think his point was right. Like, I think a lot of GPs are very cavalier about, about the things that affect LPs and understanding that things like J-curve actually really matter to some people.
Hey Superclusters fans, David from Post here. If you enjoyed today's episode, all I ask are 2 small things. 1, there's a little red subscribe button down there if you're on YouTube, and a follow button if you're on Spotify or Apple Podcasts. If and only if you enjoyed today's episode, that's the button to click. You'll get many more presents, many more insights, and many more brilliant minds straight through the internet vines just like this one very soon. 2, it'd mean a lot to me if you could share it with one other friend who could gain a lot from listening to today's Cosmos of Insights. Also, let me know if there's anything I should have asked down in the comments, and if there's enough interest, we'll have today's guest back for an even spicier part dose. I made a promise to myself to record 100 episodes of Superclusters, so every comment, question, and review helps me make this experience more helpful and fun for you, and makes investing in venture a little less scary and a lot more friendly. And lastly, I wanted to share a quick disclaimer. The views expressed in this podcast are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of any organization that we're a part of. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. And that's all from me. I'll see you on the next.